Welcome, Gen Z accounting students and future CPAs. Listen, if you are aiming to absolutely crush the Management Advisory Services, or MAS section of the LECPA board exam, you are in the exact right place. This explainer isn't some basic read from the textbook review. No way. We're building your ultimate brain-friendly study guide designed specifically for long-term retention. We are literally going to build a mental map today that will stick with you for the next 2 or 3 years until you finally sit for those boards. Okay, let's dive right in. We're essentially building a mental filing cabinet today, so you can easily pull out these exact answers on exam day. Here's the game plan. We're hitting line versus staff, controller versus treasurer, the CMA objective, IMA ethics using the CCIC standard, resolving conflicts, and then wrapping up with a rapid-fire LCPA bullet review. All right, Section 1, line versus staff relationships. Let's look at the corporate battlefield. To really get what management accountants do, we first have to understand how a company's hierarchy actually operates. Over on the left, we've got line management. Think of these folks as the commanders on the battlefield. They are directly responsible for hitting the organization's main goals, like production and marketing, and they literally have the authority to command downward. Now, on the right side, we have staff management. Their absolute superpower? Support. They provide advice and backup to those line managers. Functions like management accounting, HR, and IT, those are staff functions. So here's what you need to dual code into your brain right now. Line equals command, staff equals advise. Okay, pause. Here is a classic LECPA trick question. Let's lock in this study hack. The controller primarily occupies a staff position, right? Because their main job is to advise the whole company. But, and this is a huge but, they hold line authority over their own accounting subordinates. So if the board examiner asks if the controller only has staff authority, you know for sure it's a trap. They command their own team, but advise everyone else. Moving right along to Section 2, Controller versus Treasurer, the heavyweights of the financial food chain. Let's see how this structure builds into the specific roles at the very top, where powers absolutely must be kept separate. Here is your primary memory anchor. The controller is your chief management accounting executive. Their focus is completely internal, and their main function, recording. The treasurer, on the flip side, has an external focus. They're the executive making the financing decisions, and their main function, the custody of assets. Now, here's the golden accounting rule to avoid incompatible duties. The recording function, so the controller, must never hold the custody function, the treasurer. Let's walk through these duties using that internal versus external anchor. Look at the controller's column. Notice how it's all about internal data and reporting. Planning, control, financial reporting, tax administration, and government reporting. It's all inside the house. Now look at the treasurer. They're looking outward, provision of capital, investor relations, banking, short-term financing, insurance. So if an exam question drops a word like banking or raising capital, your brain should immediately snap to treasurer. If it mentions taxes or internal reports, boom, snap to controller. All right, Section 3, the CMA certification, the internal counterpart. We all know the CPA is the ultimate goal you are grinding for right now, but you should also know the specific professional standard for the internal management accountant. That's the Certified Management Accountant, or CMA credential. The 4 objectives here are pretty straightforward. Establish management accounting as a recognized profession, push for stricter educational standards, provide an objective measure of competence, and encourage continuous professional growth. Think of it as the internal accountant's counterpart to the CPA. It's a globally respected credential that proves you have the strategic chops to go way beyond just crunching numbers. Section 4, IMA Ethics, the CCIC standard. Okay, pay attention, because this topic is highly testable on the MAS exam. Literally, the moment you sit down for the board exam and they hand you that scratch pad, I want you to write down these 4 letters, CCIC. That stands for competence, confidentiality, integrity, and credibility. These are the 4 absolute pillars of the Institute of Management Accountants' Statement of Ethical Professional Practice. Let's break down exactly what the examiners are going to expect you to know about each one. First up is competence. And notice something important here. Competence isn't just about knowing the math or being a technical genius. I mean, yes, it definitely means maintaining professional expertise and following the law. But a massive, often overlooked part of competence is recognizing your own professional limitations. Actually, it is perfectly competent and professionally required to raise your hand and admit when you just don't have the expertise for a specific complex task. Next is confidentiality.
This obviously means keeping information secret, except when you're legally authorized to share it. But here's the hook they love to use on the board exam. It explicitly includes monitoring your subordinates. Yep, if your team leaks confidential data, you are the one held responsible. You have to ensure compliance across your entire team and absolutely never use confidential info for an illegal or unethical advantage.
The I stands for integrity. And here is your active recall hook for this one. Integrity is all about saying no. It means mitigating actual conflicts of interest, advising all parties of potential conflicts, and just generally abstaining from anything that discredits the profession. So, if a board question involves a supplier offering you an all-expenses-paid weekend to a beach resort to win a contract, turning that down falls squarely under integrity. Finally, we have credibility. Students actually confuse this with competence a lot. So the crucial point to remember is that credibility is all about the fairness and objectivity of your communication. It means disclosing all relevant information, even the ugly stuff. If there are delays, deficiencies in information, or internal control problems, you must explicitly disclose them. It's about making sure the numbers aren't manipulated just to make management look good.
Section 5, Resolving Ethical Conflicts. The escalation path. All right, so this is where theory hits reality. What happens when your boss tells you to break those CCIC rules? Here is the exact chain of command you must follow. Step 1. Discuss the issue with your immediate supervisor. But notice the big exception, unless they are involved. If your supervisor's the one doing the manipulating, you bypass them entirely and go to the next management level, like the audit committee or the board of directors. Step 2. Clarify the issues confidentially with an IMA ethics counselor. Step 3. Consult your own attorney. The massive takeaway for the exam here: never ever jump straight to the media or an outside attorney without exhausting this chronological internal hierarchy first. Section 6 LECPA Bullet Review. Time for some rapid-fire memory. It is time to lock all of this into your long-term memory with a rapid-fire review of the most highly testable concepts we just went through. Here are your LCPA memory anchors. Say them with me and burn them into your brain. Line equals command. Staff equals advise. Controller equals internal recording. Treasurer equals external custody. The CMA objective equals professional recognition and competence. Your ethics mnemonic is CCIC. Competence, confidentiality, integrity, credibility. And for conflict escalation, go to your immediate supervisor first, unless they are the ones involved. If you master these anchors, you are going to absolutely fly through these questions on exam day. I want to leave you with this final active recall challenge. Imagine you are a management accountant. The controller pressures you to manipulate financial reports to artificially increase executive bonuses. Based on what we've learned today about roles and ethics, should you report this issue to the treasurer? Think about it for a second. The answer is absolutely no. The treasurer is a completely separate external custody function, not the next level of management. You must escalate to the next higher internal authority above the controller, like the audit committee. How well did you spot that trap? Keep practicing these mental maps. Stay laser-focused on that 3-year goal, and I'll see you in the next explainer.